So I recently heard about this thing called payday loans, so I wanted to ask Dad, what are they?
Okay, so a payday loan is an advance against your payday, whenever you get paid
What does that
next.
mean? An advance?
It's money you get today instead of waiting until the day you get paid next. But it's not your payroll provider giving it to you. It's not your employer. It's a third-party company. They tend to charge the highest interest rates in the world. I mean, they're really bad in terms of the interest rates that they charge, but they'll give you money today against what your next paycheck is going to be. And when you get your next paycheck, they're expecting you to pay back the money plus the interest that they're going to charge on it.
Right, and that's where I'd originally heard about this. I was watching some YouTube video and it was someone talking about how they took a payday loan of 500%. And I'm thinking, what does that even look like? Who who's paying that? It's not a bank.
No, it's a private money lender. And there are less restrictions on private money lenders on what they want to put out money at. The reason is that they're not a bank where they're holding deposits from people. So banks are much more regulated because they're holding people's money. A money lender doesn't hold people's money. They just give out money to people in return for the interest to get it back. So they can charge interest rates that are pretty horrible.
And not regulated. Like that's not a they
It-
can
it-
set their own.
That's higher than I'm aware of it being legal, but this person may not have dealt with someone legal. I mean, there's an entire underground economy of illegal lending, right? So, I mean, well,
Another video.
that 500%. Think of it this way. If you have 2 weeks until you get paid, 500% is roughly 40% per month. So if you have 2 weeks to get paid, if they charge you 20% interest for that 2 weeks, you borrow $1,000 and you have to pay back $1,200 in 2 weeks. That's about a 500% interest rate on an annual basis because you had to pay 20% for 2 weeks. If you had to pay a normal interest rate for 2 weeks, let's say, 12% interest rate, it would be 0.5% for 2 weeks,
Right.
not 20%, which is 40 times higher.
Yeah,
right?
that's really high. So
It's
this is something.
extremely high. So payday loans are known as being kind of a gouging kind of an industry. They are not highly thought of. They're thought of as preying on those who are least able to pay money back. And they will tell you that, well, they have to get the highest interest rates because a lot of people don't pay them back. So to make a profit, they have to write off a lot of loans. Write off meaning accept the fact that they're not going to get paid back money from some people. So
Yeah.
that's why they have to, that's what they'll say is why they have to charge so much money. But it is not a really highly respected industry. It's sort of like storefront companies. It's typically unfortunately, like the poorest among us that get dragged into this because they have no other alternative option.
Yeah.
And in foreign countries, there's something called micro lending that a lot of people in America invest in, which is like business loans to people in Uganda or something like that, I wish there were more micro lending in the United States instead of payday loans. I wish that existed here in the United States instead.
All right, so payday loan, it's third party, usually quite risky, usually like the highest interest rate
Yes.
among any kind of money lending possible. Probably wouldn't recommend it.
Find another alternative if you can.
Amazing. Well, thank you for helping us understand that more deeply. Please like, subscribe, comment, and we'll see you soon.